A lot of people think that the mortgage process is basically over after they get pre-approved. But hey, it's not. It's just getting started. Getting pre-approved is absolutely a big step, but there's still a full process ahead of you. Underwriting, appraisal, title, homeowner's insurance, final credit checks, employment verification, asset review, and all the details that come up between the contract and the closing. And the part that buyers don't always think about is that sometimes the problem isn't the house or the lender. Sometimes the buyer creates their own brand new problem for themselves right in the middle of it. So today I'm walking you through the things that you should not do after you apply for a mortgage. Some of it looks harmless, but in the mortgage world, a harmless looking decision can delay a closing, change the approval, simply be an annoyance, or in some cases, kill the whole deal entirely. So every one of these things I'm about to talk about, I have seen firsthand, and it wasn't always a solvable problem. Sometimes the deals died, and sometimes people lost money. I know this might sound like some guy in a video telling you what to do. And in reality, that's exactly what this video will be. But sometimes we need people in our life to tell us what to do, and more importantly, what not to do. So settle in and get ready for a lesson. By the way, my name's Josh High, Swift Home Mortgage, Brandon, Florida. I'm a mortgage broker, been doing this for a long time, so this experience is real. Don't finance anything after you apply for a mortgage. Once you've applied for a mortgage, don't go finance anything. Not a car, not a living room set, appliances, no new credit cards, not one of those no payments for 12 months deals at the furniture store. You know, something as simple as $87 a month will still count in your mortgage approval. When we approve you for a mortgage, we're looking at your income, debts, credit, and your assets, and your full monthly payment. So when you add a new debt in the middle of a process, the file changes, and a changed file can change the approval. Buyers will say all the time, but I was already approved. And yes, you were approved based on the file we had at that point. Furniture is one of the most common examples because buyers get excited. They want to furnish that new house, and the salesperson says, hey, no payments for a year. This isn't going to hurt you at all. This will be fine. And it sounds good, but if that account shows up before closing, now we have to deal with it. And depending on the numbers, it might push your debt ratio over the edge. The rule is simple. Until you close, don't finance anything unless your lender has looked at it and looked at the numbers and told you that it'll be okay. Not the furniture salesperson, not your buddy, not your uncle who bought a house in 2002, your lender. Here's a quick story about this exact same scenario. A couple years ago, we had this person clear to close. We had to wait about 2 weeks until the closing date hit. This person went to a furniture store, Ashley Furniture, racked up about $11,000 in a furniture credit card, no payments for the next 18 months or whatever the number was. We get a hit from the credit bureau saying, hey, this person has applied for new credit. That's normal. We always, if that happens during the process, we get an alert saying that you're trying to open new credit. What's going on? So we go to them. We say, hey, it looks like you applied for credit. We have to ask you, did it result in new debt, or is it just an inquiry? Did you just apply and not take debt? Well, sure enough, he took debt, that $11,000, roughly whatever it was. He signed up for a new card, didn't have any payments on it, but that new card did not yet generate a statement because it's brand new. We've got like a week left between the time that we have to fix this problem and then get him to the closing table, and it blew up his debt ratio. He didn't have enough money monthly to afford the new house, all of his other debts, plus this new debt that he was signing up for, even though it was like a 12 or 18 month introductory zero payments or whatever they do there. We have to hit him in his debt ratio, and we didn't have the ability to maintain the approval. So what did he have to do? He had to go back to the furniture store, get to the manager, unwind the whole entire thing, do a refund, get everything back, and cancel that account. And we had to document all of that. Now, if you don't have an online account yet with the credit card company and you don't have an account active at the store, what does that mean? That means you don't have documentation. And documentation is the name of the game here, and that's what we had to get. So he had to go back, he had to get printouts, he had to get letters, he had to call in. It was a nightmare for him to chase all this stuff down when he could have simply just waited a week and been completely in the clear. Wouldn't have been a problem at all. So these things happen and they get ugly. A lot of times we can save them, but nobody wants to be in that stressful position. Number 2, don't buy a car in the middle of buying a house. This one gets its own section because it happens all too often. Don't buy a car while you're trying to buy a house without talking to your lender first. A car loan can absolutely derail a mortgage approval, and it doesn't have to be some outrageous payment. A few $100s a month can be enough to throw the file off. Maybe you still qualify, but now the approval is tighter, or maybe we have to change loan programs due to debt ratios, or maybe you need more money down, or maybe the loan gets more expensive because the rate went up or the PMI changed, or maybe the deal's just dead altogether. The worst situation is when we find out that that car has already been purchased. And at that point, we're not preventing a problem. We're clearing one up, or attempting to, and there's a huge difference between those two things. If you want to buy a car or a truck, close on the house first and then go pick it out. A question you might hear from your lender is, do you plan on living in that new car? Tip 3, don't move money around like you're trying to hide treasure. What is it with people having so many bank accounts with no money in them? Like, why can't you have just 1 or 2 bank accounts that you do all your business through? Don't start moving money all over the place after you apply. People sometimes push back on this one because it's their money and they don't understand why or where it matters where they put it. The answer is that to a mortgage file, we have to document where the money came from, and we're not just looking at the balance on closing day. We're looking at the paper trail. We have federal anti-money laundering laws and the Patriot Act to thank for all this extreme documentation. So if money starts in your savings and then moves to your checking and then gets transferred to your spouse and then comes back to you, but you added some cash along the way in the deposit, and then you send it to the title company as your escrow deposit, you may have just turned a simple little asset review into a documentation marathon nightmare. That money might be perfectly fine, but tracing it takes time, and that's something you don't have a lot of when you're under contract. You're going to be online a lot, printing out transaction histories and trying to request statements and all this kind of stuff. A transfer from your savings to your checking account is usually not a big deal. We may need statements from both accounts, but that's fine. A gift from a family member has a proper way of documenting it. Selling something means we need to know what it was, who bought it, what the value was, how the money came in, and how to document that correctly, showing it wasn't pulled out of thin air. Pulling from retirement means you need the right statement and proof of access. That's common. The point isn't that you can't move money. The point is that a quick conversation with your lender up front turns what can be a messy documentation problem into a non-issue, minimal documents involved. Tip number 4, don't deposit cash. Don't deposit cash into your bank account during the mortgage process without talking to your lender first. Cash feels like money in real life, and it absolutely is. But to an underwriter, cash is a documentation problem because we can't easily verify the source. Remember, the government tells us that money could be laundered or it could be used for terrorism. Which is it? If you deposit $2,000 cash and say you've been saving it at home, that might be completely true, probably is, but it doesn't automatically make those funds usable for the loan. The lender has to verify where that money came from, and cash from a drawer or under your mattress isn't going to cut it. All of that can create a real issue if suddenly it shows up on the bank account right before closing. If you have cash sitting around, tell your lender early. Don't wait until the week before closing to drop it into the bank. That's how straightforward files turn into complicated, messy ones. Tip number 5, don't change jobs without checking in first. I completely understand that life happens to all of us, but try not to change jobs during the mortgage process without talking to your lender first. Sometimes a job change is totally workable. Other times it creates a serious problem. And like everything else in the mortgage world, it depends entirely on the details. Moving from one full-time W-2 salary job to another one in the same field, or maybe even another field, we can often work with that. That's usually not an issue. But moving from a W-2 salary job to a 1099 or a contractor position, that's a totally different conversation. Going from salary to commission or to a heavy bonus structure can create a problem. Changing your hours can create a problem. Starting a business can create a problem. If the new job has bonus income, overtime, tips, or any kind of variable pay, we might not be able to use all that money right away because of how the guidelines treat income history and stability. Variable income guidelines typically want to see 2 years of that income to prove stability. People assume a better job or higher pay always strengthens the file, but that's not always true. A higher income doesn't automatically make the deal stronger. The type of income, the documentation, and the history behind it all factor into how we can use it. If you're thinking about changing jobs while you're buying a house, make the call before you make the move. I had a client one time, he was a truck driver, and he'd been there for years, like 5+ years, made good money. And during his mortgage process, after he had a contract with his escrow money and his appraisal money spent and all that stuff, he decided that he was going to leave his W-2 driving job and start an LLC and become a contract employee for the job that he just left. So guess what that did? That totally blew him up because he went from a W-2 earner to a self-employed person with 0 months on the job. So in order to be a self-employed borrower, you have to have 2 years of business history and tax returns and show that you've been in business for 2 years making money. All right. So what did he have to do? He had to dissolve his LLC and go back to work from the employer that he left in order to get his approval back on track and maintain his employment and be able to close. Huge bump in the road, lots of stress, delayed closing, all of that. So pro tip, don't do that. Tip number 6, don't quit your job because closing is basically done. Don't put in your notice because you think the loan is basically wrapped up. Lenders can verify employment right down to the closing date, sometimes the day of. So if your employer gets a call and they say that you no longer work there or that you've put in notice to leave, that loan has a serious problem, even if it was clear to close the day before. If the income that was used to approve you is no longer there, is about to go away, that approval might not be there for you either, especially if you're using your income. So even if you hate the job, if you're planning to leave, or even if you have something else lined up, close on the house and then make the move. Tip 7, don't ignore document requests. This one isn't dramatic, but it's one of those bigger reasons why files get stressful and cause delays. When your lender asks for something, there's a reason, I promise. I can assure you that we don't want any more documents from you than we need. We don't collect them for fun. Maybe underwriting wants a clearer copy. Maybe a statement's missing a page. Maybe a pay stub doesn't have enough detail, or a deposit needs more explanation, or maybe the insurance quote changed the payment and now the numbers need to be updated. So I know it can feel like it's repetitive, and sometimes mortgage paperwork does feel like you're submitting the same things more than once. Typically, that's not true. Typically, they're a little bit different or something was missing. But going quiet does not make the request go away. It just eats up your timeline. And as a loan moves forward, when conditions get cleared and you're the one who can clear them, that's on you. And we try to do what we can to make it work for you, but we need you to cooperate and don't go quiet. Bank statements, pay stubs, letters of explanation, gift, documentation, employment details, whatever the file needs, the faster those things come in, the smoother everything goes for you. If we could do these things on your behalf, we totally would, but you hold the keys and the passwords and the accounts for all of that information. We can't get to it ourselves, okay? Tip number 8, don't treat your pre-approval like a golden ticket. A pre-approval is an important, huge first step, but it doesn't guarantee every property is going to work. It doesn't guarantee the appraisal is going to come in right at value without repairs. It doesn't fix any title issues that might be out there. It doesn't make a bad insurance policy or premium disappear. And it doesn't protect the approval if your income, credit, debts, or assets change along the way. A strong pre-approval should be based on actual documentation, not just a quick credit pull and a conversation. But even a strong pre-approval still has to survive the rest of the process. The house has to qualify, the numbers have to hold, employment gets verified, assets get documented, and the underwriter has to sign off on a full, complete file with all these questions answered. So get pre-approved, absolutely, but don't get sloppy after that. A pre-approval puts you in a position to buy. It doesn't carry you all the way to the finish line. Tip number 9, don't wait until the last second on homeowners insurance. This is especially true here in Florida. Don't put insurance off until the week before closing. Insurance can change the entire feel of a deal. It can raise the payment, push up the debt ratio, increase your cash to close, and depending on the property, it can create a financing problem all of its own. In Florida, insurance is not a minor line item anymore. Roof age, wind mitigation, water heaters, flood zones, prior claims, electrical systems, condition of the property, coverage availability, all of that affects what you're going to pay for a premium, and what you pay affects your monthly payment, which affects your debt ratio, which affects your approval. So once you're under contract, get insurance quotes early and send them to your lender so the payment can be updated and we know what we're working with. The payment that matters is the full housing payment, including taxes, insurance, mortgage insurance if applicable, and HOA if that's applicable. So finding out 3 days before closing that the insurance number is way higher than you expected is not a good situation for anyone. Tip 10, don't hide problems from your lender. There are 3 people you need to be 100% honest with at all times: your doctor, your lawyer, and your loan officer. Don't hide problems. A problem that surfaces early is almost always easier to solve than one that shows up at the last minute. If you've changed jobs, say so. If you've opened a credit card, tell me about it. If you've missed a payment, let me know. If your down payment is coming from somewhere different than what we originally discussed, bring that up. If your hours got cut, if there's a divorce, a lawsuit, a garnishment, a layoff, a furlough, anything that could affect the file, the time to bring it up is as early as possible. Late surprises are what wreck closings, and that's the scenario where the buyer is upset, the agent's upset, the seller's upset, the title company's waiting around, and everybody's trying to figure out what to do and looking for a miracle before that Friday closing. So if something changes, tell your lender as soon as possible. Staying quiet does not help you in any way. Tip 11, stop taking mortgage advice from random people. During this whole mortgage process, keep that advice circle small. Your friends and your parents and coworkers certainly mean well. The car salesperson, he doesn't care about your closing. The furniture store guy doesn't care about your approval. The person in the Facebook comment thread in a group doesn't know your debt ratio. Your cousin who bought a house 7 years ago doesn't know what's in your file. Mortgage approvals are specific. Your credit, your income, your debts, assets, loan program, property type, occupancy, taxes, insurance, and timing all factor into that approval. Other people don't know what's going on in this process besides you and your lender and maybe your real estate agent. What worked for someone else in a different situation, in a different year with a different file, may not apply to you at all. So before you make a money move, check with a person who actually is going to be working on your loan. Tip 12, the safest rule after you apply: don't freestyle your finances. Don't open new credit, don't close accounts, don't move large amounts of money around without talking to your lender, don't deposit cash, don't co-sign for anyone, don't change jobs, don't finance furniture, and don't randomly pay off debt without asking first. That last one surprises people because paying off debt's usually a good thing. Other times it creates a documentation issue or it depletes the cash that we may have needed for closing. So if you paid off a $10,000 credit card and you only had $15,000 to put onto your loan or to your down payment, that $10,000 is gone because we had to use it as verified funds to pay off debts. Could be a problem. So even when you think you're doing something that improves your file, check first. None of this means you're frozen in place until closing. It means the mortgage process has rules and guidelines, and a 5-minute conversation up front is a lot easier than cleaning up a problem that's already happened. Getting pre-approved is not the same as being done. You still have to protect the approval. Don't take on new debt. Don't move money around without guidance. Don't deposit cash. Don't change jobs without checking first. Don't ignore document requests. Don't wait on insurance, and don't hide problems from your lender. The mortgage process gets a lot easier when your lender knows exactly what's going on early in the process. That's how you avoid late surprises and keep a good approval from turning into a problem. If you're thinking about buying a home and you want someone to walk through this full picture with you before you even start making offers, reach out. That's what I do every day. I'm here to help you figure out where you stand, what to watch out for, and how to move through this process without stepping on a landmine. We're easy to reach: swifthomemortgage.com, getwithjosh.com for an online application. You can call me or text me 813-606-4255. I hope you found some of this information valuable. And if there's anything I can do for you, I look forward to talking soon. Have a great day.